Let me ask you something. If a recession hit tomorrow, is your investing portfolio ready? Okay, we have seen signs of a recession or economic slowdown. In the US, consumer spending is softening. The debt is rising rapidly with military parades ongoing like nobody's business. Geopolitical tensions are everywhere. Russia, Iran with Israel and things like that. In Singapore itself, MES also recently highlighted a muted growth outlook for year 2025. So now I'm not here to make bold predictions. I believe in preparation, okay, not panic. So in today's video, I will walk you through 6 defensive stocks that can provide stability and long-term resilience. And before we dive in, I will also share how I personally filter for all these all-weather stocks using a simple but powerful analogy. So how do I pick defensive stocks? Think of it like building a house. You want, number one, solid walls, right? Economic moat, competitive advantages that will protect your house. Number two, strong foundation. The foundation comes from this fortified balance sheet where you have a low debt, strong liquidity, strong cash flow, and also healthy interest coverage. So even when maybe the sales go down, you have sufficient cash to pay out your borrowings, because borrowings is the thing that kills a lot of listed stocks and make them bankrupt. And number three, steady income. So you want the ability to generate consistent cash flow even during economic slowdown. And if a company has all three of them, it can stand through a financial hurricane. And the best part of all, if most of these stocks, right, somewhat like defensive stocks that pay dividends, so they are great for retirees or anyone who enjoys a passive income. By the way, if you enjoy content like this, breaking down investing into simple, relatable frameworks, feel free to subscribe or join my free weekly newsletter at investkaki.com. I share weekly updates on Singapore and US stocks and what I'm personally watching. With that, let's hop on to the top 6 defensive stocks right now. Let's move on to the exciting part, the 6 defensive stocks during a stock market crash. So stock number 1 is ComfortDelGro. We all take public transport through thick or thin, right? Rain or shine. ComfortDelGro is the best stock in Singapore when it comes to transportation because they are the market leader in especially the taxi industry. Even though we have Grab, we have Tada, ComfortDelGro still dominates the market with all the taxis. Their core revenue, 85%, essentially comes from the public transportation services. Other than taxis, they have buses, trains under their subsidiary SBS Transit, inspection, testing services through another subsidiary called Vicom. Balance sheet rock solid as well. With that, they are able to generate a lot of free cash flow, pay out dividends for almost more than 15 years. So regulated industry and defensive. So what's there not to like about ComfortDelGro? Second stock that we have, Lingling. Lingling is another retail REIT. I call it like the HDB of Hong Kong shopping malls. Super central, high footfall, and anchored by daily needs. So even during COVID, right, people still bought groceries and essentials over there in the Lingling shopping malls. If you take a look, other than their close proximity to all the transport hubs, they are also exhibiting a very strong balance sheet, almost close to 30% gearing ratio. So they have a lot of debt room to acquire other more expand overseas like in Singapore. And you can see from the 3 malls here, they are actually under Lingling itself. And they have been paying 17 years of dividend growth. Current yield is around maybe 6%. So the takeaway here is that kind of defensive and they are still paying or dishing out quite decent dividend yields for us to put it on our watch list. Moving on, the third stock is SGX. So if you have been taking a look at what's going on in the Singapore market, even though we have IPOs coming down, not a lot of IPOs ongoing in Singapore, the fact is that SGX is targeting all these DRs, partnering with a lot of derivatives partners, and SGX is what I would call the casino operator. So they have a monopoly. They are the sole securities and derivatives exchange in Singapore itself. So be it whether we win or lose, they take a cut. And 65% of the revenue comes from trading and clearing fees. Not so much on the trading volumes are not that high. They are still having a bulk of their revenue from all this. Volatility, although it plays a part, but if you take a look at their track record, their dividends have been ongoing for more than 20 years across the different market crashes that we have gone through. Current yield is not that much at around 2+% because the share price has moved up quite a bit. That being said, they have zero debt. That's rare these days, and it's one of the few companies that you will not be able to miss. They have a very strong credit rating. The house always wins, right? So SGX will profit from all these kind of upcoming the MES 5 billion launch or things like that. That will revitalize the Singapore market. Moving on to our fourth stock, Referral Medical. This is a healthcare necessity provider, and I believe that health doesn't wait. Be it markets going up or down, people still need to see doctors and need to go for medical surgeries. Raffles Hospital is one of the best flagship hospitals for the region, the Southeast Asia region, where overseas tourists will come in to just perform this kind of state-of-the-art medical surgeries. And with all the healthcare demand going up, especially with aging population, more and more people are getting older and requiring all these medical services. I believe that the healthcare demand will continue to rise regardless of the economic conditions, because you will pay how much it requires no matter how the economy is doing, right? Because it's your health. And on top of that, because of defensive business model, they have very strong balance sheet as well. Okay, I believe right now is sitting at more than 200 million in cash. And with that in mind, they have been expanding in China. They expanded to China with hospitals in Chongqing, Shanghai, and Beijing. So there's both the defensive aspect as well as the growth potential if their China hospitals stabilize after a few years of startup phase. I mean, takeaway is here. Health doesn't take a recession. Demand for quality healthcare will always remain there. Moving on, the stock number 5, I decided to go for the US market. PepsiCo is one personally I prefer because I do buy their consumer product, be it like the Pepsi, because I don't have a preference for either Coke or Pepsi. If Pepsi is available, I will just go for Pepsi. And the more important part is about their snacking business. I prefer to have Lay's potato chips because that's what my wife likes. I don't really give up on them during the financial crisis. If you take a look at their brands, they have 23 brands across the world, each generating over 1 billion in annual sales. So with all this in mind, I believe they do have a bit of pricing power in a sense that they are able to increase prices even during economic downturns. So that is the economic mode they have, and they are a dividend aristocrat. They have been paying 50 years of dividend increases. Right now, they're sitting at around a 3% dividend yield, pretty stable and pretty decent. And PepsiCo is like comfort food for your portfolio. Steady and reliable. You can depend on it for a long time. And the last but not least, I have McDonald's. Golden arts, golden dividends. Here's a fun fact. McDonald's actually grew during the 2028 financial crisis. Why? Because of value meals. Think about it. When our wallets shrink, right, you will not go for restaurants. Instead, you go for cheaper alternatives like McSaver meals, like this, a $5 meal. The proof is in the pudding. 45 years of dividend increases. You need to eat a lot of Big Macs to get that consistency. Interest coverage ratio is 13 times as well, and they have more than 40,000 global outlets through their franchise models. So that is fascinating. And I myself, McDonald's at least once a week, so I'm pretty sure of their business model as well. So final advice, assess your risk tolerance. Consider your investment timeline and comfort with the market volatility. Second, remember to diversify across all these different sectors. Go for defensive sectors, especially during economic sessions like utilities, transport, healthcare, and real estate. You should also reinvest these dividends, grow your portfolio, be it whether what the market volatility looks like, so that you can compound your returns through all these So there's no need for FOMO. You don't need to go for like hype stocks, like for example, crypto stocks or the best SIA stocks. You can just use all these dividends to reinvest and go for consistent compounding. Found today's video useful? Give it a thumbs up and hit subscribe so more investors can see it. Leave a comment down below. Which of these stocks do you own and are planning to research further? And if you haven't already, join 9,000 plus readers in my free weekly newsletter over at investkaki.com, where I share market insights, stock ideas, and personal investing lessons every single week. With that, signing off and see you in the next video.